Okay, in this next video, I'm going to talk a little bit about how Wall Street really works. Now, when I sit down with a prospective client, usually I'll explain exactly how the financial system is run and how it works, and usually I get a look of amazement from some of these people. They had no clue how it really functions. We see these commercials on TV where the broker or the planner is sitting on the beach with the couple and helping them develop their dream house, or sitting there as the child's graduating from college and how they made it happen. Well, when you really start to look at it, the reality is very different than what they're trying to project. Again, as you go through this, I think you're going to find out that Wall Street's there for one reason, and that's to generate fees. That's it. You'll get to understand a little bit more about why it works that way and how it works that way as you watch this video.
The first area where perception does not meet reality is in qualifications. Most people think that brokers and planners are very well qualified. They're educated on all the various financial topics, that they're essentially financial experts. That's not the reality. The reality is all it takes is somebody to pass the Series 7 to become a broker. And the thing is, this test doesn't even require people to understand tax issues or estate planning or retirement planning. All it does is it teaches people how to transact, how to sell bonds, how to sell stocks, what they need to do that. It doesn't teach them anything about the theory of finance and how to help you achieve your goals. The other thing is that people understand is the laws are set to where brokers are assumed to be salesmen, not actual planners. So they're held to a much lower regulatory requirement. This is a big issue, and most people really don't understand this. The other big thing you have to realize about Wall Street is they're there for one thing, to generate fees. They're not there to make sure you meet your goals. They're there to generate fees. And they do this through one of three ways: investment banks, the mutual funds and insurance products, or principal trades. Now, investment banking, if you don't know, what they do is they raise capital for companies. So if Disney's going to build a new theme park in Brazil, they need to either issue more stock or bonds to raise money to do this. Well, the investment bank essentially goes out and raises this capital. They get a cut of whatever they raise. So they're trying to raise as much money as they possibly can. And that's where all of these brokers and planners come in. They are the distribution channel for the investment banks. Most big brokerages make a majority of their revenue from their investment banking arm, not from their brokers. These investment banks want to make sure that their brokers can find buyers for all of their products. So usually what they have is analysts who will hype up the certain companies that have an investment banking relationship with the underlying company. There's just a lot of dirty play when you're talking about the investment banking arm. In fact, there's been all kinds of fines and levies against investment banks because they're finding out that a lot of these companies really didn't think too highly of the underlying company, but they hyped them up because they had an investment banking relationship with them. In fact, it was Elliot Spitzer who really went after a lot of these big brokerage houses a few years ago. Now, of course, Elliot Spitzer has his own little integrity problems, but it doesn't take away from the fact that he uncovered quite a bit of dirty tactics where these companies were pushing products on their clients when the reality is they didn't like them themselves. So the investment banking presents a lot of different of conflicts of interest. This slide shows some of the biggest firms that were fined $1.4 billion for misleading clients with their investment banking arms. And you can see some of the biggest names on Wall Street are here, and many of you probably have brokers at these firms. The second way Wall Street makes most of their money is from the mutual fund and insurance companies. Just like at a grocery store, it costs a lot more to have your product at the eye level rather than having your product at the top shelf or bottom shelf. It's the same way for mutual fund and insurance companies. They pay the brokerage houses extra commissions in order to get their product pushed to the end client. So when you're sitting in front of a planner, that planner may be recommending a certain annuity or mutual fund. Now, how do you know that they're not getting a bigger commission for pushing this product rather than selling you a different product? The thing is, you don't know. And there's a lot of conflicts of interest in this manner of selling. This is why I always recommend avoiding folks who are paid commissions. Because once you mix products and advice, the client's best interest is a thing of the past. Here's a mailer I got one time offering a 13% commission on an annuity. So if you sold somebody an annuity with $100,000 in it, the broker or planner gets $13,000 up front. That's just massive. Now, which annuity do you think they're going to sell you if they're sitting with you as you're discussing buying annuities? Here's another one I got in the mail that said, hey, if you're the top producer, you could win a BMW Roadster. Again, what annuity do you think you're going to be pushed if you're sitting in front of the advisor when he's competing in this contest? The third way that Wall Street makes most of their money is from a thing called principal trades. And this is the most nefarious way that they do it. You see, all the big Wall Street firms have their own portfolio just like you and me. They own stocks and bonds and commodities and real estate. Now, if they decide that they want to sell, let's say their Disney stock. So they want to get rid of Disney. Well, they're not going to dump Disney on the market because the price would go down substantially and they'll take some losses. So what do they have to do? They have to find buyers for Disney. So they get their brokers out there finding clients who will buy Disney. So the firm gets rid of their Disney shares and offloads them to their clients. Now, if this isn't a huge conflict of interest, I don't know what is. But this goes on all the time. The worst example of this that I found was when Enron went under. It was found out that H&R Block advisors had sold Enron bonds that they had on their portfolios to their clients literally weeks before they went under. They found 200 brokers had sold to 820 customers in 40 states. H&R Block had made more than $500,000 on this, and why did the brokers do it? They got paid 3 times the normal commission to sell those bonds. What most people don't realize is when you sign a contract with a broker, it's literally written somewhere within the contract, probably in very fine print, and it says, our interests may not be aligned with yours. So you have to ask yourself, do you really want to trust your financial future to people who are telling you that, hey, we may not be working in your best interest. We may be doing something that's in our best interest. Another thing most people don't realize is your broker is not obligated to get you the best price on a stock or bond sale or even give you the lowest cost product. They will never be punished for selling you an annuity or a mutual fund that costs substantially more than an equivalent mutual fund or annuity. They're held to a suitability standard, which I'll explain now.